Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Today, I'm going to be giving you guys a different presentation. So if you were here last Tuesday, or you keep coming back to watch this presentation because you love infinite banking, well, I'm going to shake it up today. I'm changing the presentation we're going to be doing a little bit. It's going to be a little bit shorter, a little sweeter, change up some slides to give you guys some more information and different examples. So if this is your first time being here, welcome. This is going to be a fantastic presentation for you guys still. But for those of you who have been here many, many times, this will kind of change it up a little bit. So hopefully you guys like it. And as always, I want our chat to be interactive. The more you guys communicate, the more you guys are listening, asking questions, putting your thoughts in the chat, the better you're going to understand this, the more feedback you're going to get from others, and the better experience you're going to have today. So guys, everybody be interactive, be enthusiastic, and let's get started. And I want to start with a different question than I usually start with, guys. So I want to ask you, and everyone respond in the chat, answer there. How many of you are business owners of some sort? Whether that's an LLC you own that has some rental properties, whether you own a large corporation, whatever it is, how many of you are business owners of some sort? But great, I saw a few of you guys there. Yes, no, a few of you. Awesome. So I want you guys to imagine something real quick. Just close your eyes. Imagine you guys owned a business. You owned a restaurant. If you guys owned a restaurant, where would that restaurant be in your city? Where would you want it to be? What kind of cuisine would you serve? What would your waiters and servers and everybody there wear? What would be the vibe of your restaurant? You guys have that in your mind? Would you guys go out to dinner with your friends and family? And would you take them to your restaurant or somebody else's restaurant? You'd be so prideful and excited about sharing what you love with your friends and family. You would take them to your place, right? I see some in the chat. Yeah, all day long. What if it wasn't a restaurant, though? What if it was a salon or a barber shop? You guys had your own place. You guys did hair. Would you guys get your hair cut at your salon or barber shop, or would you go to the person down the street? You wouldn't go to anybody. You'd go to your own shop, right? And what if you owned a gym? You guys ever go to a gym and see the gym owner working out somewhere else? No, they're always at their gym. And the last question for you guys, to get your mind thinking about what we're going to talk about today, is if you owned a bank, would you make deposits in your bank or Bank of America or Wells Fargo or Chase, your bank, right? If you needed a loan for a car, a house, a rehab on a property, would you go to your bank and borrow the money? Heck yeah, you would. If you borrowed money from your bank, would you pay your bank back with principal and interest? Absolutely. You wouldn't steal from your bank, just like you wouldn't steal from your salon, your gym, your restaurant. You don't steal from your business. So for you guys here today for the first time, why don't you guys all own your own bank? Interesting thought. That's what we're going to talk about today. How you can become your own bank. And this is going to be a 200-year-old strategy that has been used by the wealthiest families in history to utilize their money, eliminate taxes, and build wealth. And we're going to show you exactly how they did it and who did this. And for me, being here, I want you guys to know it's not just me telling you this strategy works. There are thousands and probably hundreds of thousands who have used the same strategy as well. And for starters, some big names. You guys all probably should know them, maybe not all of them. You guys know this guy, Mr. Rothschild? The Rothschilds used this strategy. If you know them, you know the Rockefellers. Most people know the Rockefellers. It's a household name, I feel like. This is Mr. John Rockefeller. He indeed used this strategy. How about Ray Kroc? You guys know Ray Kroc? You know what business he owns or owned? McDonald's. Do you guys know what business McDonald's is in? Some think they're in the business of selling burgers, but in all reality, they're in the business of real estate. That's what they do. And why and how do you think they started that business? I'm going to show you how. And what about Walt Disney and Disneyland? So there you go. When he was broke in poverty during the Great Depression, he started Disneyland using this strategy. And any football fans out there, you guys know Jim Harbaugh? When he got his last contract with Michigan and became the highest paid college football coach, he incorporated this strategy into his pay and his salary. He's setting up himself, his kids, and grandkids to be wealthy. It's pretty cool. So how can you incorporate the strategy like I have, and you guys can too? And just for you guys to have a little bit of confidence in who you're listening to today, I want to share 2 seconds about who I am. I'm Carson Herlean. I work with Chris Naugle, as most of you know him. That's my wife and I. We live in Southern California, where we love to be outdoors. We love to surf. We love to travel. But over the past few years, I've met with over 3,000 families across the country one-on-one, teaching them this wealth building concept. And this has allowed Anna and I to buy millions of dollars in real estate, travel the world, and really build a strong foundation to build generational wealth. And my story is pretty simple. I'm sure actually most of you can relate to it. In my early years, I made a lot of mistakes, as we all do. But I did do one thing right. When I was 18, I went and served a church service mission, and I lived abroad for a year. And it was great. But when I came home and I was in school, it was interesting because I had a lot of outside influences pushing me different directions. And really, in one hand, I held the traditional route, corporate America route, being in the finance industry, as going to school, learning about all these different things. And in this other hand, I was around business owners and entrepreneurs and real estate investors. I saw the freedom and control that they had. And I had to choose, which direction do I want to take? Which path do I want to go down? And I actually made a decision to drop out of school and pursue an education in investing and learning how to make money work for me, and then teaching people that. And it's changed the course of my life. And I am early in my journey. So I really hope today to share with you guys what I've been so fortunate to learn already. And you know what? The more I learned about money, the more I realized actually that I didn't know much. The more I realized it's kind of an ever increasing financial journey to really get it all. And there's always something new to learn. And so when I pose this first question for you guys, I want you to stop and think about it. This first question is, could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Genuinely think about that. That should be a yes for most of us, but I don't think we'll really ever get to a point where we know everything about money, right? And so this question is powerful because I want you guys to think about what you're not already thinking about and what you haven't yet been taught. And I hope that when it comes to money, we can have a humble kind of learner mentality throughout our life. And I'm sure a lot of you guys have read books like Rich Dad, Poor Dad, Money Master the Game, different money books, Richest Man in Babylon. These books all talk about many financial strategies and tools, but the main thing that's always constant is they always say, save money. You can't save and keep money, you're screwed. And so they say save at least 10% of your income. Most people say at least 10%. And I hope you guys here today do at least that 10%. But in today's economy, most Americans save between 3 and 5% of their total income. It's not enough. In our American culture, we don't value savings. We don't value the retention of our dollars. And I think the reason that is because the environments we've been told to store our wealth are so incredibly inefficient that it makes it hard to do it. Places like savings accounts, high yield accounts, 401ks, even CDs, they're inefficient. And it's hard to save money because those are the places we're told to store it. And so what I'm going to talk about today is a function of how your money moves, and it's called banking. This is a major paradigm shift for most people because it's different. And the interesting thing about banking is that it affects every single component of your life, whether you understand it, you control it, or you don't. So wouldn't it be smart to understand it and control it, right? If it applies to everything in your life, yeah, you want to know about it. And so throughout this presentation, I want you guys, and I urge you guys to keep an open mind. Because once you see the banking world as I see it and how it actually can complement your life instead of go against you, you'll never be able to look at money the same way again. And so I said in the beginning, I was going to teach you guys how you can set up your own bank, right? It's the very first thing I said. Well, what if this bank you were going to set up was going to replace your current account at somebody else's bank? Right now, you use somebody else's bank to invest, to save stuff, to build up funds. And that's called Wall Street, pretty much, financial institutions. But what if every time you needed to buy something or invest in something, it came from and to your bank? So let's start with a few attributes of what you'd want your bank to be like. First, what is the bank? Well, we'll show you. Let's compare it to storing money in a traditional bank. I want both accounts to be liquid. Well, I want my bank to be liquid just like a traditional account is. If it's not liquid and I can't touch anything that goes in there, then I don't want to keep it there. That's not efficient. We need liquidity first and foremost. Liquidity is pretty much the only attribute of a savings account or any other account we store money, right? It's just liquid, that's it. And so that's the only attribute going for the traditional bank. But when it comes to our bank, it is also earning interest. Let's call it 2 to 6%. Let's say it's guaranteed. Let's say it's uninterrupted and compounding on itself. Those are some big words and they all mean a lot of different things. But let's hone down here. If it's guaranteed, that's awesome. What accounts are guaranteed? If it's uninterrupted, meaning if you ever were to touch it, it would not stop the dollars from compounding. That's pretty freaking cool. Nothing really has that. And it's going to compound. Albert Einstein said the eighth wonder of the world is compound interest. Why? I'm not going to get into compound interest calculators. I'm sure you've all heard examples, but it's important to have compounding growth. And traditional savings vehicles right now, I think the average amongst all savings accounts is 0.07%. Not good. And when you get that 0.07% return, it's, guess what? Taxed. You get taxed on that. And in your bank you're setting up, what if I told you were going to grow tax-free and protected? If you were ever in a lawsuit, judgment, lien, the market crashes, your money would be safe in your bank. Whereas in a traditional vehicle, it's not safe, nor is it stable. We're in an economy like today, we need stability. So if your bank that you stored your money had all of these attributes right here, wouldn't that be an efficient place to store money? This would be a place you could control, you could count on, you could use as the foundation to finance everything throughout your life. And I get it too, because life's busy. You all have lives, you all have things you got to do and work on. So the opportunity actually though to put money somewhere that's still liquid when we need to use it for emergencies or whatever it is, but it's also going to be compounding, guaranteed, tax-free, risk-free, which is a big one. And what if I was to add, if you were ever to take money out of your bank, like I said earlier, it would not stop compounding. Now that's something that every American should dive deeper into. Wouldn't you guys agree? Let me know in the chat if you do, or if you don't, let me know too. But wouldn't you agree that if you could store your money in a place that did all of this, you would? So let's get into what this bank is and how we can use it to become the bank. So what is the machine we're setting up? What is the machine we're going to use to be our bank? And this machine is only going to be used for one thing. And that one thing is running your money through it. Okay. Right now, again, we use somebody else's machine called the bank, called Wall Street. But we're going to change that one thing, and that's going to be where your savings, where the money you keep, goes. It's going to go into this machine. And before I even tell you what this machine is, I want to remind you of a quote by Will Rogers. He said, "The problem in America isn't so much what people don't know. It's what people think they know. That just ain't so. What we've been taught about money may not actually be the truth, guys. So don't judge what I'm about to share with you quite yet, because you might not understand it. But the machine we use to do banking with is nothing more than a dividend-paying whole life insurance policy from a mutual company. Now, don't freak out and think I'm here to sell life insurance. Like, calm down for a second. This is not normal life insurance. This is not life insurance you're going to get from your local insurance agent or your broke brother-in-law that sells insurance. It's not this. This is a specially designed and engineered whole life. And a lot of people have questions at first because they're like, Dave Ramsey says whole life's bad. Buy term and invest the difference, right? Honestly, I'll agree with those guys. If you put money in a regular old whole life with the expectations of it doing what I'm about to show you, you'd be really upset. This is a specially designed and engineered whole life, just like the Ford Focus in the dealership. Okay, what I mean by that is, you guys ever go to a Ford dealership and see a Ford Focus in the driveway, car looking like this? Basic car, nothing super excited about it, but it's a car, right? But what if I told you that if you go on YouTube and look up Ken Block with the Ford Focus, you would see somebody going 150 miles an hour drifting around a turn in this car. The only difference between that first car and this Ford Focus is the design and engineering of the vehicle. The specially designed whole life insurance policy that we design looks nothing like regular life insurance. It actually looks more like a supercharged bank account. And you know what? Many of you probably still aren't believing this quite yet, or if you've been here for a while, chime in, tell us how you might have a specially designed policy and how it's working for you. But those of you who are new, remember a few minutes ago when you said you would agree that if there was a place to put your money that had all of those benefits, you would. Well, that's what this whole life policy can be if it's structured correctly. You might just haven't learned how these policies actually work yet, or you've maybe been sold the wrong thing in the past. And here are the main things you hear about whole life. Common sayings. You hear low rate of return, it's expensive, or it's the worst investment. If you're watching this, please write this next part down. If you don't remember anything from today, remember this next portion. Whole life insurance is not an investment, guys. It's not. It has nothing to do with investing. This is about control and a banking conversation I want to have with you today. It had nothing to do with investing. If you guys could take anything, remember that. So when you guys go home and talk to your neighbor, your partner, your business partner, or another insurance agent or something, and he starts or she starts telling you, don't do this old whole life thing. It's actually a terrible investment, I've heard. It's got a low rate of return. As soon as you hear somebody call whole life an investment, you now know that that person has no idea what they're talking about because they can't even correctly identify what type of asset it is. You cannot get a policy built for banking like I'm going to show you from a regular insurance agent or a financial advisor. You only can get policies like this from banking professionals, which is what I am. So listen to people who know what they're doing and know what they're talking about. And if we want to mimic what banks do and become our own bank, then let's just do what they do. That easy. So my question for you guys is, what do banks do? You ready? This might blow your mind a little bit. This is interesting. Look this up. BOLI, bank-owned life insurance. It stands for bank-owned life insurance. If you were to look this up, what you will find is that you'll find that banks own more whole life insurance, not IULs, not term insurance, whole life, than they own in land and buildings combined. Banks are the #1 purchasers of these whole life insurance policies in the world. Not only do they own more whole life, they're buying more every single year. So you need to ask yourself a question. Are banks stupid, or do they know something that I don't know? Guys, these 4 banks right here, 4 biggest banks, they have over $60 billion in whole life. They're not stupid. They're smarter than I am, smarter than you are. We just need to mimic them. That's all we're going to do. And this whole strategy was actually written by a guy named Nelson Nash. He wrote a book called Becoming Your Own Banker. Every single one of you should get this book the second you're done with today. Fantastic book. It's a short read. But he mentioned the problem with just money in America in general is that you have to finance everything. What does that even mean? Well, it means you either borrow money and you pay interest on it, which is what commercial banks want you to do, and then you're choosing to store your wealth with commercial banks, or you were taught to save up the cash and pay for it cash and not get a loan. But what no one ever taught you with that method was when you used your own money and you actually spent all of it, you bought it cash, whatever it was, you are now giving up the interest that you could have earned on that money. And that is called an interest cost. And that interest cost doesn't just last 1 year. That's the cost of the rest of your life, the money you could have earned on that amount. You chose to spend it instead. And so this is the problem with what we do with America. And when you calculate that idea of, hey, every time I spend money, if I spend it, I lose it. I can no longer earn on it again. I can't keep the money I'm making. If you put that number of earning for the rest of your life on every single purchase, that number becomes so substantial. And so when you know how to apply that to everything you spend your money on, it gets ridiculous. And the problem here is that everything we do, all items that we have to be financed, and they're being financed with other banking organizations. So we've been taught to get into business or to invest with other people and give our money to other people and lose control of what we're making and keeping. And the bankers control it all, whether we pay cash or we finance it. The bank's at the core of it, collecting, controlling, and making profit on all of the hard work we're doing. This is why you need to become the bank. So you can be in control of these transactions, so you can be the one earning interest always. Okay? So how do banks actually work? Here's how banks work. You deposit 100 grand into your bank, let's just call it, and it's making 4%. You have a great high yield account. You're stoked, making you 4%. You deposit your 100 grand at the bank. You're happy, right? Well, that money now is sitting with the bank, and that is a liability to the bank. So they immediately go and lend it out. They're going to lend it out to somebody else on a mortgage. Say they lend it to somebody at 7%. Well, then when that individual buys the house, they close on it. They pay the seller. Who puts their money where? Right back in, right? Who's going to lend the money out again to somebody needing a car at 8%? Who's going to pay the car dealership? Who's going to put the money right back? Who's then going to pay or give a loan to somebody else? Maybe somebody needs a home remodel loan at 9%. Who's going to pay their contractor for the goods and services they provided? And the contractor is going to put their money when they make the profit right back in the bank. Let's say somebody else needs a debt consolidation loan. They pay them 12%, pay off their credit card, and the credit card companies put it right back in the central bank. Guys, think about this. Who's in control of all these transactions? The bank. Well, you're making 4, you're making 7. They're making a 3% spread. Well, you're making 4, they're making 4% spread, 5% spread, and an 8% spread. They're making a whole lot on your money while it's sitting there. If you total all of that up, they're making 20% more than you are on your money every year. And 20% goes into 4% how many times? 5. So they're making not just, some would say, hey, you're making 4, they're making 20, they're making 16% more. No, they're making 20% more than you. So that's 500% more than you. 4 goes into 25 times, like I just said. So the bank's making 500% more than you are on your money in this scenario. And if you actually go to BauerFinancial.com, you will find that banks make between 400 and 1,300% on your money every year when you leave it there. You can go to any bank's actual annual report and find that. There isn't a bank in the country that makes less than 400%. So when you go to any small town, big city in America, and on the main corner of every city, what's there? A bank. They have the nicest property in town because we're paying for it. So earlier when I told you that these banks are the #1 purchasers of these specially designed whole life policies, the thing I said was, are the banks stupid, or do they know something you don't know? Guys, they're smart. They know what they're doing. And so now that, we're 25 minutes into this, real quick, sum this up. We've laid the framework of what banks do, why you'd want to become the bank, the power of whole life insurance, and the credibility behind it. So now let's go put this into action, and let's give you some real life examples and numbers of how you can utilize whole life as a bank. Okay, here we go into some examples. I'm going to show you how to buy a car, and how to buy a car and get back every single dollar that you ever put into the vehicle. Real quick, as we go into these examples, I'm pulling up the chat to see what everyone's doing. Great comments, everybody. This is awesome. No questions. Fantastic. Well, so if you do have any questions at this point, write them down maybe in the chat or in a piece of paper or something, and we're going to get to Q&As at the very end. But we're going to go through some numbers here. I'm going to show you guys how to get back all the money for every car, truck you ever buy, drive, and own. And we're going to start with the machine again. Now, don't focus on this chart quite yet. Let me pull this up. Sorry, I had to get a sip of water there. So the machine we're looking at. This policy here on the right shows you the premium, the cash value, death benefit, buying a car, and all that. Forget about it for a second. I want to talk about this policy, how we're setting it up, and some frameworks for you to kind of live by and think about when you're going to be using this. And so we really need to change our mindset when we start this, because we think about premium. When we hear the word premium, it's a payment, it's an expense, it's a bill. We hate it, right? Health insurance, home insurance, car insurance, your premium is terrible. You don't like it. But life insurance can be different if it's structured correctly. I actually look at my life insurance premium as what I call a deposit because it's liquid. And I've never met anybody who doesn't want to deposit more money in their bank account, right? And if your insurance policy is structured correctly, it is exactly that because you can immediately use it. So we need to start changing the way we think about premium, and you need to start thinking about it like a deposit as we do. And the next thing people talk about is age. Oh, I'm in my 40s, 50s, 60s, 70s. People sometimes even they're in their 30s and they're saying, am I too old to do this? I'm like, dude, come on, chill out here. First of all, you're young, but age doesn't matter because if you were to go get normal life insurance, yes, it matters for the cost of the death benefit, for sure. However, when I'm building this policy, I'm building this for the premium and our deposits and the cash value, not for the death benefit. I'm building it for the banking abilities and banking attributes I get out of storing money in the policy. I'm not setting this up because I want some cool death benefit or $2 million on my life. That's not the case. If the person setting up the policy was 20 or 60, and we said, hey, we want to put 10 grand a year into a policy, it's 10 grand a year. Either way, there's no difference. We're choosing how much we're putting into it. The difference would be the older individual would have a lot smaller of a death benefit than the younger. But that doesn't mean the policy is not going to grow the same or be used the same. It doesn't matter. So the death benefit does not matter, or sorry, the age does not matter, and kind of blends in with the death benefit too. It doesn't really matter as much because we're using this for the cash value, not really the death benefit. But you will eventually learn that the more you use your policy, the bigger your premiums are, the more money you're running through it, the bigger the death benefit ends up being. So you actually are kind of setting up your kids to exceed even more or excel even more when you start using this more, which is interesting. Now that you have an idea of kind of how we look at this, let's talk about more of those numbers on that right side I was just showing you. So let's say you had a policy. This is actually an example of somebody we work with, and they wanted to buy a car, and they were saving 10 grand a year just regularly in their savings account. So we said, hey, instead of doing that, let's save 10 grand a year in your policy. So they did. First 7 years, they deposited 10 grand a year. Fantastic. And then this cash value on the right side here, that's the liquidity. That's how much he was available to take out of his policy. So year one, he deposits 10 grand. And remember what happens with your deposits and what you're paying into the life insurance policy. Growth, guaranteed, tax-free, protected, paying for you to have a death benefit, and in a stable environment in life insurance companies. So that's what's happening with your 10 grand once you deposit it in the policy. And then the insurance company says, hey, now that you've deposited money here, you've paid for this death benefit, we'll let you leverage it. You want to take a loan against your policy? That's called cash value. You can take a cash value loan against your policy whenever you want. This is how much is liquid and available for you to access. Year one, about 6 grand, $5,800. Year two, 12,000. Year three, it drops to 4 because we're going to show this person taking out 25 grand out of the cash value to go buy a car. Okay. So he's now paid 10 grand in year number 1, 10 in year number 2, 10 in year number 3. And he's built up this cash value that he can use and leverage. He takes 25 grand out and goes and buys a car cash. Brings it home stoked. Okay. Then what's he going to do? Well, everybody, if he's setting up his own bank, he's going to be taking a loan against himself. What should he do with this loan now? Pay himself back. A car note at 25 grand, let's call it $500 a month. He should pay himself back what the traditional going rates are right now and pay himself back $500 a month. Like if he was to take a loan from anybody else, he'd pay them. Why not pay himself back? So he does. He pays himself $500 a month. That is 6 grand a year, and does that for 5 years, 60 months, just like any car note. Okay. Now let's look at this. $70K in premiums. Right, in year number 1, he's paid $30K to repay his loans out of pocket. He also took a loan for 25 to go buy the car. So you could say the net injection into the policy is 75 grand. That all making sense to you guys? 75 grand is the net injection into this policy. Look at the cash value in the 7th year. It is 67,881. That means he had access to 91 cents on the dollar. He put in 75 and had access to 67, and he got a car fully paid for sitting in his driveway. So he got back 91 cents on the car he just purchased. Does that make sense? I'm going to go through this example one more time so you can kind of wrap your head around this, but I'll go even further. Let's say after the 7th year, he chooses to not pay any more premium. No more premium deposits into his policy, which you can do after 7 years. So no more premium deposits, but he needs a new car now for his kid or his wife. Takes out 25 grand from the cash value again as a loan against himself, against his own policy, his own appreciating asset, and goes and buys a car cash down the street. And then pays himself back $500 a month, just like he would pay anybody, right? Now let's look at that. No more premiums, $30K to repay himself. He took a loan for 25. So his net injection into this policy is 5 grand. So he put in 5,000 in that 5-year period. And look at the cash value. It grew from 67 to 91. His cash value grew by $23,000, and he put in just 5. He made money off of buying that second car. Did I not tell you I would show you how to get back all the money you could have ever bought or paid for, or put into a car you purchased? Let's look at over this whole 12-year period. He put in 75K in the first 7 years, 5 grand in the next 5 years. So 12 years into this thing, he's put in $80,000. And he has 2 cars fully paid for in the driveway, paid off. And look at his cash value at the end of 12 years, 91 grand. Put in 80, has access to 91, and has 2 cars. He just made 11 grand off buying 2 cars. That is indeed the case. Before I continue, I'll let you think about that for a second. Does that make sense? Guys, there's 3 rules when we do this that we need to kind of abide by to make sure this all works. Rule number 1 is pay yourself first. He was saving 10 grand a year. And instead of giving it to financial institutions, whether that was a 401k or a CD or a savings account, he chose to pay himself and put it into a private vehicle, a whole life insurance policy. Rule number 2, when he took a loan from himself, he paid himself back principal and interest. He was an honest banker. And rule number 3, he recycled and recaptured the interest. He paid himself back what he would have paid somebody else in interest, and he just repaid him the interest. He recycled the interest. He recaptured the money he was going to pay somebody else. So if this works for, let's say, a car, what else does it work for? Everything. Okay, anything you do, you can finance through a car, through a policy. And next, I'm going to show you a couple other smaller, shorter examples, but different. Let's say you have a debt, a line of credit you need to pay off, right? And it's 23 grand, and it's a line of credit at your local bank at 9%. Okay. So what you would do in this scenario, let's say you had the money to pay off a line of credit. What would you do? Would you just spend the cash and pay it off? No, you would not. We would want to dump it into the policy first and then pay it off. Pay ourselves first and then pay off other people. So he dumped in 30 grand into his policy, took out 23, paid off his line of credit. That's cool, right? He changed one thing. The only thing he changed was where his money went first. It went into his policy. So he dumped in 30K and immediately right away took out 23 and paid off the line of credit. But then you got to think to yourself, well, okay, well, if I need to treat my money the same way as the bank's money, then you would need to pay yourself back, right? So how would you pay yourself back in this scenario? Well, the line of credit payment was $289 a month. So wouldn't he just kind of recycle and recapture that payment? He'd start repaying himself $289 a month. So guys, look, it's just a circle. It's just a circle of how your money moves. Your money starts over here on the left, and then it goes to work for you on the right, and then the money comes right back in and cycles back up. It's that simple. Are you guys starting to see kind of how this works now? Now you have $300 a month going back to you, and you are paying 9% on that. So what does that mean? How many times are you guys making money in this transaction? Once in the policy, you're making a spread inside there, just like the banks do. And then the second, by taking back that 9% you were giving away to the bank and paying yourself that. And to highlight that further, think about this for a second. Remember the attributes in the very beginning I showed you that come with whole life insurance. Well, you know what that means. Your 30K you originally deposited into the policy It's still compounding, right? It's still growing forever. You never lost the 30 grand. If you would have just spent the 23 out of pocket and paid off the line of credit, you would have lost it. It's gone. Poof. Sure, the debt's gone, but you lost the 23 grand you saved up. So by dumping it into the policy first and then paying it off, now you're in control. Now you're earning on that money first and forever. And then, yeah, you'll leverage it to pay off your debt. That's great. We'll do that. That's fine. But now you're never going to lose money on anything you purchase ever again. You will run everything through your bank first. So your dollars never lose the ability to grow. That's what we want to do by being the bank. If this was an investment, let's say you wanted to invest in Private Money Club and someone was going to pay you 12% a year. Well, you take 23 grand out of the policy. If it was the same example, run it to the investment, pay somebody else, have them do whatever the deal is. And then when they pay you back every single month, the interest, recycle and refill the policy. You can do this over and over and over again.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
So, as we sum this up, I want to hit this real quick. Only one of two things are going to happen to us throughout our life. Okay? One, we're going to live. We all will live. We're all alive. Are we better off with this than without while we're alive? Well, I just showed you ways to recycle and recapture money, pay off debts quicker, buy things and get money back on it, make money 2 times in investments. Yes, you're better off with this while you're alive. And what if you passed away soon or a long time from now, hopefully? Is your family better off with this or without? They're better off with it. They're going to get some lump sum paid to them when you pass away. A huge death benefit's going to go to them because you chose to pay yourself first. If you just kept doing the traditional way you're doing things now and let it sit in a bank account, that's all they get, which might end up being nothing. So now you're setting up not just yourself, but your family to build that generational wealth like those people in the beginning did. The Rockefellers, the Rothschilds, the Disneys built wealth through the strategy the same way. So to wrap everything up, guys, I want to let you know we're going to have about 15 minutes here for Q&A. So stay on. Think of your questions. They're probably going to be great questions. But I want to thank you guys for lending your time with me today. And I hope you guys are going to do some amazing things with this and actually take action. You guys are in a position to set this up no matter how much or how little you make. No matter the situation, your age, you are in a position to protect your money and build wealth just like everybody else is. This strategy is very important to me and our team and many other people we've had success with. And we want you guys to have the same. I have my email here at the bottom. If you guys want this presentation emailed to you or the replay sent out to you, or you don't know where to find it, or if you want more resources, more videos, more examples, more numbers, I will email you whatever you want and share that with you guys. And if you guys want to set up time to meet to discuss how this system could work for you, would love to help you. This strategy is free of charge. We help people set up these policies and we're paid from the insurance companies. But by you setting up a policy, that's it. There's no other cost or charge beyond that. You're going to set up your own bank for your family and that is it. The link I just threw in the chat is my calendar. If you want to set up time to meet with me, I think Matrice, I think that's you just commented. Right above you is my link to my calendar. Please book time with me to meet. We can talk about how you can set this system up for yourselves. But I have a few minutes here for questions and answers. So I'm sure there's many things we can talk about here. I've seen different questions throughout the presentation. I'll probably try and go back into. Someone said, what about for someone who's in their late 50s? Is this more practical for younger generations? Even though I'm young, guys, that does not mean this is not meant for older people, older individuals. Most people I actually work with, they're in their 60s, which is funny. So no, you are not too late to set this up, no matter your age. Anthony, he responded to and said he's 16, just got his first policy. So age does not matter. Someone said, hey, I just got my policy. How should I best use my policy to strategically pay off my mortgage using a first lien HELOC? Man, that is a long explanation. This could be a very deep conversation. But just like you've probably seen in our videos, like the chiropractor paying off his debt and how he did it, he just snowballed his debt. I would do the same thing. Run your extra income into your policy and then use the policy to chunk down the HELOC And over and over and over again, you would do that until the HELOC was paid off. Once it was gone, then you'd start recycling that money and that payment and just repaying the policy, and then kind of doing velocity banking with your policy at that point. Ryan said, it came in late. Is there a way to get a replay? Yes, Ryan, email me. My email is on the screen. I will send you the replay afterwards. After 7 years, can the person continue depositing for savings up to the permitted limit? Yes, you can actually fund a policy like this your entire life, and that would actually be the goal. We showed in that example of paying off or stop paying premiums after 7 years, but that was just a simple example. You would actually probably want to and would contribute your entire life or until you no longer produced income. So yes, you can contribute after 7 years, and you most likely would. Someone also asked, these are great questions, guys. Keep pumping them in. So is there a grace period where you cannot access your money when you first start making deposits into the policy? I mean, yes. Once you funded the policy, I would wait a couple weeks, make sure everything processed. You can log into your portal with the insurance company and all that jazz. But then you can request a loan from the cash value pretty much right away. So there's not really a grace period. I would just make sure everything's set up okay. We always say take your first loan within the first 30 days of the policy being set up. Now, you also don't have to take a loan. You could wait 3, 4, 5 years and never touch the policy before you need to use it. It could just be an emergency fund for you, so you don't need to take a loan, but you have the option to right away, yes. What is the interest rate at which the policy is growing? Norma said. Norma, appreciate your participation and your question. Would love to help and would love to set up time to meet with you to talk about this concept within your life. But you asked, what is the interest rate at which the policy is growing? The insurance company pays you interest and dividends forever. Historically, those dividends are about 8%. These insurance carriers we work with have been around for over 100 years, every single one of them, and they've paid dividends every single year consecutively. And historically, it's about 8%. Right now, in a lower interest rate environment, as we have been the past 10 years, I would say, most dividends have been around 5 to 6%. Someone said they clicked the link and it wouldn't work. Let's see if I can put it in here better. If you want to type this in as well in your own Safari, carson.beyourownbanker.com. That I've never seen that not work. So that should work. I just clicked it as well and it did work. So maybe I didn't put it in right the first time. Next question. Can you build the cash value on the policy before withdrawing from it? Not sure what you mean by that, Jose. Can you build the cash value on the policy before withdrawing from it? I don't know. If I own the policy on a family member, how would I be able to surrender the policy to that family member in time? So on life insurance, there's an insured body, the person the policy is actually on, and then there's a beneficiary who the death benefit will get paid out to, and then there's an owner of the policy. The owner of the policy does everything. They pay the premiums, they manage it, they take out loans, they control the money aspect of it. The insured does nothing, just the insured body on it, and the death benefit gets paid out to the beneficiary when the insured person passes away. So if the policy is on you and you own it, and then just your spouse or children or trust is the beneficiary, then that's that. But you can actually change the owner of the policy whenever you want it. So you could have the policy on a child, set it up for them, you fund it, you manage it, and then when they hit 20 or 30 or something, you change the ownership to them and let them start funding it and using it from that point forward. Totally an option. These are crushing these questions, everybody. Is this policy a type of policy that's a mutual company? Million %, yes, you would want to get a policy from a mutually owned life insurance carrier. We are licensed and contracted with 6 different insurance companies. Every single one of them is mutually owned. Every single one of them is over 100 years old. Every single one of them is A+ rated or higher. So yes, we work with some strong companies and we can help you set up those policies and teach you how to become the bank using them. A couple people said they were able to book time with me. Great. So the calendar did work. Can you put money in one time, a lump sum? Fantastic question, Diana. That's exactly right. You can set up some premium deposit where, like the example I showed was 10 grand a year. And then up front to get it started, you dumped in whatever you had sitting in a savings account or retirement account or something, say it's 10, 20, 30, 100, 200 grand. Yes, you can do one-time lump sum into the policy to get it started. Be a fantastic idea. I'm just wondering if you have to take money out first from a policy. Jose, you're responding to my question to you, I assume. You don't have to take a loan from the cash value. No, you can never touch it if you don't want to, I guess. Can I put a lump sum initially? Yes. Can I just hit that? Let's see. Great question here, Timothy. So I mentioned a trust. Do you suggest that everyone be in a trust? So No, the owner of the policy would not be the trust. The owner of the policy would just be you personally. The beneficiary of the policy, so who the death benefit would get paid out to in case of passing, that would be the trust. So you can have a trust be involved. You don't need a trust involved. But if you did have the trust involved, it would just be the beneficiary. It would not be the owner of the policy. And you can actually also change the beneficiary at any point of the policy too. So not like a huge hurry. You can set the policy up and then a few years down the line, add a trust into the mix, but not something you need to do. No. Is there a limit to how much you add to a policy? Yes, there is. There's some guidelines and restrictions, but it's dependent upon your age, your income, your assets, your investments. There's kind of a lot involved to that. So yeah, I think that'd be more so a question for us personally to figure out one-on-one because I'm not totally sure. But I will say, I saw someone said that they wanted to set up time to talk. Norma, you probably should too if you want to talk about that question. Again, throwing my link in the chat just again here so you guys can set up time to meet with me. Another question somebody said, I will keep their name private, but they said, what if you are not only in your 60s, but also have been diagnosed with a terminal illness such as Alzheimer's? Can you still qualify for a whole life policy? Tough question. Most likely no, probably not. Even though we are using this policy for banking and all that fun stuff I talked about, you do still have to qualify for life insurance and probably would not qualify in that scenario. But what you could do is put a policy on a kid or a grandkid. Same thing. You run your money into it. You control it. That individual could own it. It would just be on somebody else's life, an insurable person, which would be a kid or grandkid. Someone said for a single payment, should the person pay tax on the profits obtained during the time with the loans or if they withdraw them? I think you're mixing a lot of terminology here, so I'm going to try and repeat that question in a more understandable way for maybe everybody. And tell me if this is right, Carlos. I said, or so are you saying if you take a loan from your cash value and invest it and you make profit on that investment, do you have to pay tax on that profit? And if you do, should you pay the tax before repaying the policy or have all the income just refill the policy and then pay tax on that income from the policy? I think that's your question. Let me know if that's the case. If that is the question, you do owe tax on any outside investing you do, and you can choose to pay it from that investment income or pay it back from the policy. If taxes aren't due for months out in the future, then I would just repay the policy and have the policy pay the taxes. Yes. Well, actually, let me make sure I hit that question. Yep. Next question. How many policies can you have? This is actually interesting. You can have unlimited life insurance policies. You can literally have 500 policies, but everybody has a maximum amount of a death benefit they can have. Everyone's only insurable for a certain amount. If you make 100 grand a year and you're 50 years old, you're only going to be eligible for up to say 3 million in coverage. So if you have one life insurance policy that gets to the 3 million death benefit right away, then you can't ever get more policies unless you make more money. But you could have 3 policies for $1 million each or 6 policies for 500 each. So no, you can have as many policies as you want. It's just the death benefit's the factor there. But you could have a policy on yourself, spouse, kids, employees, partners. You could have 20 policies you own and they're just on individuals or different individuals. Someone was responding back to the question. They said about is there a maximum amount you can put into a policy or some sort of lump sum that's the max? And they said they heard one time that you could only put up to 50 grand. That's not the case. So not sure what you heard or where you heard that. We've had people put millions of dollars into these policies. So no, it doesn't really matter. How many policies can you own? Again, unlimited. I have 4 policies right now, 2 on myself, 1 on my wife, and 1 on my mother. So I have 4 that I own. And yes, Carlos Nelson Nash had 39 policies. It's pretty legit. And another question was asked at the end here by, let's see, what does it say? What's the retirement strategy we can have to get the monthly income we want in retirement? Man, that's a whole box of worms. There's hundreds of different strategies you can implement to have retirement income. I don't know the right answer to that, man. It depends is the right answer, actually. Depends what risk tolerance you have, what investing you like to do, what you know about, what you want to do, how much you have, what you can save, how much time you expect to have until you retire. I mean, million questions. Maybe you have a more specific question than that I might not be answering. But everybody, I haven't seen any questions pop up in a couple minutes here. If you do want to get more resources sent to you, learn more about this strategy, please email me. The email is on the page here on the screen. If you want to set up time with me to learn about how you can incorporate this yourself, I just incorporated and threw my link in there. If you guys want to follow me on Instagram and follow my journey of how I use real estate, because I'm in real estate, how I buy real estate, flip houses, and do it all through policies, please look up my name on Instagram, YouTube, Facebook, and follow me. We can be a part of each other's journeys. Last couple of questions. Let's knock them out. You guys are coming in. I like it. Saved by the bell. Could you go over annuities again, please? This is not annuities. We talk about life insurance. Life insurance and annuities are two different assets. Annuities, you can use an annuity as some sort of retirement income replacement. So that'd be great, but that's a different conversation. Instagram G tag, I think it's just Carson.Herleen, if I'm not mistaken. Is a health exam required? And I guess if yes, it depends on your situation. Yeah, most of the time a health exam's required. So yeah, you'll probably need to get a medical exam, and usually it's just a blood work. A nurse comes to your house, draws your blood. I entered the session late. What if you have an illness? If you have an illness, let's find out if you're insurable. Let's book some time to meet, see what illness it is. If there's somebody else you could insure. Anthony's answering the question for me. Thanks, man. All right, guys. Anything else? We crushed it. All kinds of questions. Thank you all for being here. You can group life insurance with an illness. Group life insurance is very different than what we're talking about. Whole life insurance is what you use individually to be your own bank. Group life insurance is a different idea. What's the definition of velocity banking? I don't know if I would know the definition, but I would explain it as consolidating debt into a more efficient way of paying it off by leveraging lines of credit or simple interest loans instead of amortized loans. Still trying to figure out the PUA. Paid up additions, man, are just premium that is paid up or paid off or paid for life insurance. And so there's no ongoing cost of insurance. And it's all guaranteed available in cash value. And because it's going in as premium, it's going to also earn dividends. So PUAs are really what you want to be running your money into as much as possible, because it does increase your cash value. It's available. It's going to earn a dividend just like anything else. So, you want that. And that's why most of your premium is paid up addition. Do you open a policy and then put funds into investments? Yes. Let's say you have $100,000. You want to invest in the stock market. You'd put $100,000 into the policy, take a cash value loan out, and put that money in the stock market. Now you have 100 in a policy earning interest and a death benefit, and you have your money in the stock market. So you're never going to say, should I do my policy or should I do an investment? Should I do a policy or should I do a 401k? Should I do a policy or should I buy this car? Nope. And fund your policy and invest. Fund your policy and purchase things. Fund your policy and pay off debt at the same time. That is the point. So that's what you want to do. And Rand, you have a lot to think about. You said this is very informative. I'm glad. Learn more. Everybody on here, keep learning more. I am trying to educate myself every single day. There's more we can learn. So if you want me to send you resources, please send me an email. There's more to learn about this. And if this is your first time being here, anybody, this is not going to be your last time. You need to be around this and probably see this presentation 4 or 5 times before you actually get it. And guys, you guys are pumping these questions in. This is awesome. Pay loan or PUAs first. I would pay back, or I would pay more PUAs in most scenarios. How much commission do you receive when you get my policy? Fantastic question. I'll give you an example. Let's say you put 10 grand into the policy every year, just like the further example or the old example in the presentation. If you have access, you as the policy holder have access to 60 to 80, 90% of your money, and you do, that would mean that the insurance company can't use that for their cost of insurance, their expenses, or commissions. So if you were to get a regular old whole life insurance and put 10 grand into it, you would have no money available, and the agent would make a whole lot of commission. A portion of whatever that 10 grand that goes towards is commissionable. Depends on your contract with the insurance carrier and where the premium is really going. But a portion of that's going to commission of the full 10 grand. But if we build a policy for banking and you have access to 90% of your money, then only 10% of the premium is commissionable. And a portion of that goes to us. We make a whole lot less commission by setting up a policy for banking than normal life insurance. But that's how the commission is structured. And that's the only source of income we have. We do not charge you to do this. All right, last question, and then I'm going to be done, guys. Where are you located? I am in Southern California, an hour south of LA, an hour north of San Diego, right on the beach, a little beach town. It's called Dana Point. And I grew up in San Clemente, which is right next to it. We are not super close to the fires, which is great, but it is very sad. We are close to it, and we do see smoke in the air. Last week, I guess we did. And there's a lot of people moving down from LA down to where our area is, Southern Orange County and all over Orange County. So it's played an effect on everybody down here. But not to bring up anything sad right now. I'm in Southern California. It's great. If any of you are down here, let me know. Email me. We can find a way to meet in person. I will see you guys here next Tuesday. If you do come, have a great rest of your week. We'll talk soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.